There's one major theme that has been the driver of market movements recently, but it's not focused on equity markets. In fact, it's the bond markets that have been driving recent volatility in the stock market. In this video, I'm going to talk about what the bond markets have been doing, economic reasons why traders are making that trade, and what that usually means for stock markets. Now first off, we've seen bonds selling off, and because of the inverse pricing rule with bonds, these bond yields have been massively rising. In fact, 30-year yields are already back to pre-COVID levels, so before the massive drop in yields back in March, with 20-year yields not far behind. Short-term yields, however, remain relatively flat as they're slow to rise, but long-term yields have sharply rose since the beginning of February. We can see that in the beginning of pandemic impacts in March here, that yields drastically fell from Federal Reserve actions as they began to buy bonds to stabilize and provide liquidity to credit markets. We can see from the progression of yield curves here that in January of 2020 that the yield curve is actually relatively flat, and then the Fed started stepping in and actually steepened the yield curve. We can also see by the end of last year that the yield curves actually steepened quite a bit, and this is what is known as a bearish steepening. Now, why is this a bearish steepening compared to a bullish steepening is that yields here on the longer term maturity are actually moving up higher and faster than yields on shorter term maturities. On the other hand, with a bullish steepening, you'd see yields on shorter term maturities go down faster than yields on longer term maturities. Now, of course, why is this happening is really based on one big thing, and that's reinflation or reflation expectations, and that's all from economic data that's been coming out in the past few months. So we see that economic data and indicators, especially from the recent months in December and January, show that inflation expectations are actually quickly coming back to people's minds. Now I'm going to show 3 economic indicators that for me are pretty convincing and that support the idea of coming inflation in the future. First off, we have the University of Michigan's inflation expectations, which went from below 2.2% in March 2020 to now 3%, and that's higher than the 5-year average of 2.6%. This measurement is from the University of Michigan's Consumer Sentiment Survey that looks at people's expectations of coming inflation in the future. Secondly, here we have the Producer Price Index, which is kind of like the Consumer Price Index, a measure of inflation, except this time it's measuring costs of production inputs, and they've actually now reached 2018 highs, showing a strong resurgence in demand by producers. It's also very likely that these costs by producers will be passed on to consumers in the near future, and you're going to see increases in prices at the retail level. Now, the Producer Price Index isn't as straightforward as the Consumer Price Index, as it tries to show how willing producers like manufacturers are willing to pay more just to increase their production. We can also see that if you're familiar with a Consumer Price Index chart, that this Producer Price Index chart isn't as linear as you would expect, and we're actually at multi-year highs at this level. We can also see that this index has peaked several times in the past 20 years, first before the Great Recession and also in the post-recovery. Now finally, we look at advanced retail sales, and this excludes food. This measure, released in January, aims to approximate the level of monthly sales, in millions of course, in the United States. While we see a massive drop in March when businesses were largely shut down and the country was on major lockdown, this figure shot up quickly in the summer, eclipsing the original trend. Now, as of January, we saw an even larger increase in retail sales that points to consumers massively returning and starting to spend again, especially with their large amount of savings and economic stimulus from the government. All of these figures really show that with recent economic stimulus and economic recovery and stabilization, that there will be demand side shocks coming to the economy, and that of course is known to lead to inflation. Now on to why inflation means selling bonds. Now, bonds have been selling off because inflation expectations have shifted. With the recent weak auction in treasury bonds, especially with coming inflation, usual buyers of bonds don't think that the small returns will be enough to beat inflation. As investors expect prices in the economy to rise, they think that the longer term maturity bonds will make a worse return, especially that with those low rates and low yields, they'll definitely be less attractive for those investors. Now, increases in yields, of course, act as a natural cooler for the economy as credit and borrowing becomes more expensive. Now, finally, what that means for stock markets. As I said earlier, the change in yield curve is actually known as something called a bearish steepening move. and of course that would be a bearish move for stock markets. Now, not only do bonds become more attractive compared to stocks as yields are higher, but it also points to the possibility of the economy slowing down in the future. An overheating economy may also lead to the Federal Reserve starting to tighten their quantitative easing and slow down on or stopping its monetary supports, thus slowly creating a feedback cycle in cooling an overheating economy. In the end, the sell-offs in the bond markets is only a reaction to expected inflation. If yields move high enough, it may prove to ward off actual inflation or help to slow it down before it comes, a sort of self-adjusting effect in the economy. Now, in summary, we saw some very compelling indicators that point to and support inflation in the coming future. We also saw that yields have been moving to reflect that inflationary expectation, but of course, a rise in yields can act as a cool-down mechanism for the economy and the stock market. Where stocks and bonds move in the future is still uncertain, but the idea of coming inflation is a bit worrying and should be watched out for. Thanks for watching, and as always, stay safe out there.